What up, investors? It's been a while and it's time to make a little update on the account. And after that account, I want to talk about some data to figure out whether or not we're going into a recessionary period or not. Now, of course, everything I do on this account it's not really getting affected much by whether we're going into a recession or not, but it kind of helps hedge some of the bets and stuff like that if somebody wants to act on that information. Now, I'm going to be using charts from Fred. It's not the name of a guy. It's a website that the Federal Reserve uses to put out data on any kind of economic charts that they tend to follow. So we're gonna do a little bit of browsing and see if we can gain some kind of insight into the world economy and the U.S. economy to help us determine what our next move should be and where we are in the economic cycle, or whether there is a cycle at all. So going into the account, I'm gonna do a quick review. I'm sitting at 166,000 today, up about 4,000 or about double the market percentage at 2.64. I think the Dow was up 1.3, so I'm doing really well relative to the market. I have kind of value oriented names except Apple, although I do consider Apple also value stock. These are my equities right here. You can take a browse. You can see all the information you need in the little boxes right here. The number of shares and today's change on the right in dollar amount and percentage terms. Scrolling up, you'll see all the option plays. I'm just going to scroll down through them really quickly. If you want to take a closer look, feel free to always pause the video at any point to try to figure out the exact position I'm holding. So this account is completely transparent, so you can ask me any questions about it. If you want me to take a look at some individual positions, I'm more than willing to do that. We're going to go into the account tab next before we do our little relative um, performance comparison. This is the investing tab here. I'm sitting at a near all-time high total market value of the account, only because I've pulled out so much margin, right? So I borrowed a lot of money to try to keep the account pretty active. This is far from an all-time high when it comes to the value of this account. This is just market value, so that includes all the debt. So don't get confused. I'm almost fully leveraged here at 47%, which is almost 100% of leverage. Um, anyway, I can explain that in more detail if you want. These are all the positions by equity: Apple, Smith and Wesson, Realty Income, and the Main Street Capital, etc. I have my two biggest positions are Apple and Smith and Wesson. That comprises about $200,000 of the account alone, and then Realty Income, Main Street Capital, and Paramount comprising about 100,000 themselves. So I picked up a couple new positions, just a short-term play here on the Nasdaq short and Alibaba. We'll see if something happens with Alibaba. I'm expecting a little bit of a reversal. I don't know how long I'm going to hold these two positions at the bottom. Probably not very long. But back to the investing tab. This is my one-day performance. My 1 week performance is sitting at 5.8% on the downside. 1 month performance is up 12.28%. So a lot of zigzagging there. Or you can see the breakdown here. So margin available, I've capped it out at 146. I've used it all up. Um, 3 month, you can cap your margin, by the way. You can go to over here, updating borrowing limit, and you can cap it out. I think I have up to 190 margin available right now, but I've updated it to cap it at 146. So, anyways, back to what I was talking about. 1 month performance at plus 12.28%. 3 month is down 19%, which is a big hit for me on the 3 month chart. Definitely losing to the market on that one. Year to date, I'm not doing too badly though, at negative 11%, and a 1 year chart at negative 13. I think I'm winning on the markets on the last three tabs. And of course, the all-time chart, up 129%. I started investing into this account pretty heavily, or I started taking this account seriously about August 28th, 2018, so somewhere around here. That's why the chart is flatline before that, because there was no money in it. All right, so that is the all-time chart. I'm going to compare this to the S&P 500 and see how the account fares against the markets. So on the one-day chart, the market was only a percent, so definitely winning against the market on that. The 1 week chart, market's winning actually, because I was down like 5 point something, right? So I'm winning, losing, winning on the 1 month, about doubling the gains of the market. 3 month, I'm definitely losing to the market. So it's a lot of zigzag here, but winning on the 1 year chart. So the market's down 19% almost. I'm down about 13 or something. So 5% on the market. And 5 year chart, definitely winning. Close to tripling the performance of the market in the one on the 5 year chart. What else do I need to show you? I think that's about it. If you want to see anything else, including specific positions, performances, I'll show you that. The longest position I've held is Apple, so maybe you're interested in that. You can see here that I'm up $13,000 or 15% on Apple roughly. I've increased my position to 730 shares. I'm looking forward to taking some of these off as Apple appreciates. Um, so, that about does it for that. We're going to go into some charts now. As far as the plans of the account, I'm just going to keep selling, calls and puts based on positions that I think will do well in this environment. Smith & Wesson I thought would do well, and so far it's been trading about sideways. Paramount I thought it would do well, and that's been a big losing position for me. Apple I think is always going to do well under any environment. Not to say that they're not a cyclical company, they are, but I think the money is safe there with the world's biggest, most profitable company. So next we're gonna look at some charts to try to figure out where we are in the economic cycle, and or if there is one. And I want to look at inflation basically to start with in the countries around the world to see what's going on. So going back into the charts, you'll see that this is the harmonized index of consumer prices energy for the euro area. You can see this huge boost in energy prices over the last couple of years here, sitting at an all-time high at the moment, at least for the last 22 years. So that's a big source of inflation there, right? This is the consumer price index of Germany. So you can see this uptick here that the prices have been rising steadily over the course of the last, I don't know, 50 years. But there's a little bit of an acceleration here in the last couple of years, mostly due to energy probably. But energy prices actually affect everything. So everything takes energy to manufacture. So as the energy price comes up, everything else is going to go up too. It all starts with that. So we should not be surprised about the overall consumer index going up in Germany. Um, Consumer price index for United Kingdom last 2 years, also an acceleration. And I don't know which one is the US. Oh no, I erased one by accident. Um, oh, there we go. So this is the consumer price index less food and energy in the US. Food and energy is accelerating, but you can see how much acceleration there is in other prices. So we're experiencing a lot of inflation here in the US, sitting currently at 6.4, and that's just the core. It's not the actual consumer, which is actually, it's a lot higher. But what we're seeing here is a lot of inflation upticks in the Eurozone and the US, basically kind of like a Western economy type of story. But it's not necessarily the case in a lot of other countries, namely Asia. Okay, like this is the CPI for example for Japan. Japan's been a flat line ever since the 1990s. I mean, it hasn't moved up in inflation at all. So they're not dealing with the same, maybe a tiny bit in the last couple of years. They're not dealing with the same pressures that Western economies are. How about India? Well, India's inflation, although high, is not the same as the Western world inflation. Their inflation rate's been rising steadily for as long as their economy can remember. Okay, so the Indian, I think, rupiah has just been in a downtrend, a secular downtrend for a very long time. Is it a rupee or something like that? So that's India, but China is also the same thing. So there's really no. Where's the Chinese one? UK, Japan. Oh, that's the one I erased. So maybe I can go back and find China. So Germany. You can use the site to kind of view everything. It's fed.stlouisfed.org.org. There's China. So China is not experiencing anything abnormal either. Like they've been a slow increasing inflation environment, since let's call it 2003. But nothing really changed in the last couple of years. It's pretty steady increase all the way through. So Asia is not really suffering the same as the US and the whole Western economy. There's quite a bit of difference there. Let's break down the this is the 5-year forward inflation expectations rate, which means what do you think people in 5 years will expect the 5-year inflation rate will be, which is kind of confusing. But what this graph tells you really is that since the complete crash here during the 2020s, it's been fairly steady. There was a little bit of an uptick here in February 2022, but it's actually been kind of coming down to going sideways. So people in the states, or at least people who are surveyed for this data, don't really expect inflation to go up quite a bit over the next you know 5 years. Although inflation is very high right now. This is the federal funds effective rate, and it's basically the Federal Reserve trying to chase down the inflation rate by raising rates, right? So everybody's seen this graph before. Um, Something that's maybe worth mentioning here is that there's a slight correlation here. I don't know how slight it is. Actually, it could be a major correlation between rising interest rate and then a recession following right after. So it happened here in 2000 and I'm sorry, in 1974. Happened again, in 1980, and then you can argue 81 as well. Sideways rate hikes to a slight uptick in 1990. Rates going down in 2001, still entering a recession. And then of course, starting rates starting to come down and entering recession in 2008. Um, Rising rates arguably causing the slow recession in 2020. Although obviously that year is the pandemic year, so all bets are off. And now we have a sharp rising environment that could cause a recession. However, if you look at the 1970s, late 1970s, rising rates didn't really cause a recession for a very long time, and those were sharp rises. So we could have this in the future. I mean, this could be a good analog of what's about to happen. We could have many years, 2-3 years, before a high rate, in this case, a 19% federal funds rate, arguably tipping the economy into recession. So just because we've had such a sharp rise in interest rates, it does not mean that we're gonna necessarily tip into a recession. It just doesn't. The economy could keep kicking for quite some time. So there's not a ironclad correlation. So this is the M2 money supply. I think this is world money supply. I don't think this is just the US, but it could be. I couldn't find whether it is or isn't. I think it's total world money supply. Could be wrong. So interesting to note is that the money supply has actually been flatlined to going down in the last 6 months or so. This is the real gross domestic product in manufacturing in the United States. So GDP for manufacturing. If you're wondering what gross domestic product means, it's just basically money that's turned over in a specific industry or in a specific country. In this case, in manufacturing in the United States. And that's been coming down here in the last couple of quarters. It doesn't necessarily mean that we're going to go into a recession. I mean, there's been other periods like in 2012 where GDP went down for 3 consecutive quarters and nothing really happened. So we'll see. It could keep contracting. It doesn't necessarily mean we're gonna go into recession. However, the recessions definitely take a hit on manufacturing GDP. So we don't know, it's a chicken and the egg type of thing. We don't know what comes first. Real gross domestic product in all industry total in California. This one's an interesting one to pull out because um, California rarely goes down in total industry, GDP, but there's been a lot of layoffs and a lot of the tech giants have not been as productive lately. And they've been getting absolutely slaughtered in the markets, and that kind of is reflected here in these numbers. So it looks like California is finally like entering a legitimate recession. It's hard to barely even call this a contraction here in the 2008. So 2008 didn't really hit California as hard as other states, I believe. This is of course the 2020 dip, but it quickly recovered, and now we're seeing a slowdown in the last 2 to 3 quarters. So it's interesting to note, but of course it doesn't necessarily mean that that's going to be a recession either, although they kind of go hand in hand. This is the real gross domestic product for the US, I believe. Now, real just means less inflation. Less just means minus. Okay, so real gross domestic product minus the inflation. Okay, so it's subtracted. And during the last 6 months, it's been a flat line. Now, the definition of a recession in many people's heads, including some scholars and some economists, is 2 consecutive decreases in real gross domestic product. Now, that actually happened earlier this year, but it was such a small little margin that people in the news refused, or economists, people who matter, I guess, when it comes to public opinion, refused to call this a recession, because it's so close to being flat that they kind of ignored it. So technically, if you want to look at that as an indicator, as the definition of recession, then there would be another one right where my mouse is. There'd be another thin gray line. Just in case you were confused, that's how I'm able to tell when the recessions are, because the grayed out area indicates a recession based on the St. Louis Fed's definitions, I guess. So we haven't had one since 2020, and before that since 2008. And the last chart I'm going to look at here is unemployment. Now, many people say, many people, that employment is kind of a lagging indicator. But one thing's for certain is that all of these recessions prior to now, they've had a component of unemployment spiking. Here in 1949, in 1953, in 1957, in 1960, all these recessions have been associated with a broad employment upticks that are very measurable and very meaningful. I mean, all of them, even 1980, 1981, 1990. There's zero exceptions. 2001, 2007 was a big one, right? And here, in 2020 is the most massive one of all. And it quickly recovered all the way back down to like 3.6, 3.5. And now it's holding around that area. It's true that unemployment starts normally accelerating leading into a recession. So as soon as we see these kind of one or two upticks, it could signal that recessionary times are ahead. What I will say about this though is that there's a little bit of like front running that goes on in markets and the movement of financials in general. So if there is a recession, this is going to be, as other people have noted, the most broadcasted, most predicted recession of all time, because the entire market has already positioned for it. And it's unclear whether the risk is to the upside or the downside. There's a recession priced in, it's just we don't know how severe. So the bets are about 50-50 right now, judging by the markets. It's dropped pretty significantly, the markets have, but not significant enough to warrant a very deep recession, just kind of like a shallowish medium recession. So we don't know, how much exactly, um, how the markets will react given the economic status of the economy in the next year or two. But as we saw previously, it could be based on the rate hikes scenario. It could be another few years before we enter recession, if we enter one at all. So it's not necessarily given, based on some of the stuff that we looked at so far. Inflation, unemployment, rate hikes, they don't necessarily tip the economy into a recession. Could happen. There is a correlation, but it's not necessarily the case. So our predictive power here is not that good. It's not as good as many might think. There's another chart that I don't think it's on here, that I haven't pulled up, but I kind of want to. Let me see if I can look for it live here on the fly. And it has to do with mortgage affordability, okay? Mortgage. Let's see what it says. 30 fixed rate mortgage. Fixed average United States. Let me see if I can type mortgage affordability. So there's a whole host of charts here that you can scroll through and figure out all the data that's being collected by the Fed. Let's see if anything comes up here. Oh yeah, this chart right here. I'm glad I found it. Look at this chart. This is the most telling chart of all, actually. Mortgage debt service payments as a percentage of disposable personal income. This basically means how much of a burden. Oh, you were looking at me the whole time. This basically tells how much of a burden it is for the average mortgage payer out there to pay their mortgage. And as you can see here, this is measured as a percent of disposable income, and it looks like on average it's only 4%, which is extremely low. I would have thought it's a lot higher, but this is just the interest, right? No, mortgage debt service payments, just the service payments. I don't know if that includes principal or interest, because this seems like a really, really low percentage of disposable income. Mortgage debt service payments, I think that's the whole thing, principal and interest. But either way, it's at a historic lows. I mean, the only time it was lower is, Q1 2021 at 3.5. Now it's at 3.9, which is not much higher. Compare that to the peak in 2007, that it was 7.1%, 7.2%. So almost double of what it is right now. So unless this number ticks really substantially higher, I'm not really worried about the average American being able to pay their mortgage. You see, so this doesn't really scream recession, does it? So it's not necessarily the case that we're going to be entering tough economic times, despite what, the average person may feel on the street, or despite what the data may show us with leading indicators and stuff like that, like the stock market and commodity prices and things like that. So it's not necessarily the case. I mean, the average person isn't necessarily struggling with paying their mortgage, and that's just reality. And unless that's pinched pretty hard, it's hard to say that we're going to be entering an imminent, hard recession here. So those are my thoughts on the matter. Now, does that mean I'm going to alter the way I invest? Probably not. I mean, I might make a little few hedges if I think some of the markets are overheated, but I'm not going to deviate and pull all the money out and go to cash immediately. If you wanted to do that as a trade, you've kind of already missed the boat, right? You should have been doing that in the beginning of 2001. So, yeah. All right, my volume has been pretty low. I just noticed this entire episode, but I'm gonna increase it now. Oh man, I'm so sorry. Towards the end of the video, I decided to fix the volume. So if this volume has been pretty low for the entire episode, I'm sorry. I'll fix it next time, okay? My bad. But hopefully you were able to hear what I have to say and you got something out of this video. All right, go check out that Fred site. That's it for now. Peace out.